Good to go, everybody.
Hello and welcome everybody to our webinar, our pension webinar. Today with me, I have our Vice President of the component and our team of the Air Canada component of CUPE pension team. We'll introduce, we have Hugh Chetwynd, Russ Nichols, and Nick Beveridge. Before we start our presentation, well, today the main question is, are you thinking retiring? I would like to explain the system to you. We have received some answer questions by email. On the right-hand side, on your left-hand side, you see a bar. You can type question as we go, or you could connect by phone, and at the end of the presentation, we will take all your questions. Yes, indeed. And also we're going to answer all the questions, and we're going to start with the email. The duration of this presentation will be 1 hour. So, gentlemen, I will let you start with your presentation, and thank you to all of you who are participating. And as you know, this webinar is recorded. We will be sending you a link eventually after the presentation, and you will be able to watch this video presentation at any time after. So thank you for your participation. Gentlemen, the floor is yours.
Hello, everyone. Thank you very much for joining us today or on a future recording. My name is Nichol, and along with my fellow pension committee members, Hugh Chetwynd on my right and Nick in Toronto, we're hoping to give you an overview today that helps you better understand the pension arrangement and gives you the tools so that you can understand what retiring will mean to you. We won't be able to provide you all the answers or give you every infinite detail on things, but we'll certainly give you a guide, and then we'll be able later to follow up on some of your concerns. Personally, I've been involved.
Ross, can I just say one thing? I'm not going to participate in the presentation that Ross and you are doing. I'm just here for the Q&A. So I'm going to disappear for their presentation, and then it will help. Hopefully, I can have some information for you in the Q&A. So we'll see you guys all later in about 45 minutes or so. Cheers.
And those of you in Toronto may know Nick. He's a flight attendant in Toronto. I'm a service director here in Vancouver, as well as Hugh. And I've been involved in the union since about 1980. I first started flying at Ward Air, then transitioned over to Canadian. And when we merged with Canadian, I joined the pension committee. I've worked with the Air Canada component for a long time, even in times past. I've worked with those people. So I've got a good, broad understanding of the history of things, and hopefully we can help you deal with your individual concerns.
Yeah, I'm an in-charge here in Vancouver too. I've been involved with the union. I was a local officer for 4 years in Vancouver. I've been flying for 21 years, and now I've been on the pension committee for, I think it's 4 years, maybe 5,
yeah,
something like that.
The good thing is when Hugh and I retire and it's closer on our horizon than Hugh's, Hugh will be here to pick up the slack and carry on. And also, there's another young flight attendant in Montreal, Kareem Shear.
Yeah.
Kareem, he's a Montreal pension rep, and he's also bilingual, which is great. Unfortunately, we're just unilingual, so Kareem helps us in Montreal. We've done live seminars before. We're used to that. This is a little bit new for us. We'll try to involve Kareem, and he's there in Montreal, Nick's there in Toronto, Hugh and I are out here in Vancouver. So with that introduction, I guess we should start. Now, I'm just wondering, does the presentation show on the screen, or should I follow it at the side? Like the slide point. We've got a PowerPoint. Are people seeing that, or
here it's coming?
We're loading it now. So
excellent.
Basically, and how do we move the slides?
I think Dominic. Well, there's next there. Can we move?
Can we move the slides along? Okay, yeah, this is great. If we can move the slides along, I wonder if we can make that a bit bigger. Basically, your pension in the airline is one of the more important benefits you've gained other than your wages while you've been working. And so it's important that you do understand it and plan for it. This, in a lot of ways, is a good news seminar because for a change, the pension plan is in relatively good shape financially, and you can, if you're thinking of retirement, you can head into retirement fairly confident that you will continue to collect your pension checks and that Air Canada will continue to operate as a good going concern company. Now, the one thing that we will be focusing on today is the DB pension aspect. We'll deal with hybrid pension items later. As you probably know, what has happened over the last number of years is we've merged the pension plans. There were formerly a separate Air Canada and a Canadian pension plan. Those two plans have been merged and now filed with OSFI. So there is one plan for everyone. However, you still have the same benefit formula. There's a separate benefit formula for those originally with Canadian Airlines and another benefit formula for those with Air Canada. And though we will talk about the financial aspect about it, it's important to know it's not just about the money. We'll just go through the outline here. We're going to talk about that. We'll talk about the current arrangement, the current financial position. We'll get into understanding your pension. We'll go to the Aeronet and go through HR Connects, because that's your best resource as an individual member to access the plan details that affect you and that really apply to your situation. It's tailored for you. We'll talk about the retirement process. We'll get into the non-pension retirement benefits such as travel and health, and also talk about some of the things that are available through Service in Canada, and wrap up with a Q&A. If we happen to go a bit beyond in our time and don't cover all of the aspects, we will do those later in a follow-up seminar where we will deal with them. Say we don't talk enough about the benefits. So we'll try to keep it to an hour. Why don't you
want me to go for this part?
Yeah.
This is the little disclaimer. We are a volunteer committee. We're members just like you. We'll do the best we can to describe the pension and retirement arrangement as it pertains to us as CUPE members. We are not actuaries or qualified financial planners. We recommend that you review your personal situation with qualified advisors, of course. We do our best to ensure that the information presented is accurate and correct. However, if there's any discrepancy with the plan rules, obviously the official plan rules shall prevail, much like the 356. A couple of things about the webinar, just to review if Dominic hasn't done that already. Just to turn off your mic for reduces echo issues. Questions, if you have any, should be in a general nature rather than a personal one. If, of course, you do have personal ones, please email us. We'll provide you the emails in a moment in a future slide. And of course, we'll answer the general questions during the Q&A at the end.
So as Hugh said, we're available by email. These are our email contacts. And we would suggest, however, if you do have personal pension questions, please first go to HR Connects. You can phone them, and when you get the prompts, push 2, because that's HR Connects pensions. There's HR Connects benefits, which is option 1, and that's like for health and travel and payroll inquiries. But pensions, push 2, and then you'll be connected specifically with the Aon Hewitt people that deal with pension questions. So go to them first. They're paid, actually. They're a paid team of people to answer your questions. If you don't get satisfaction or answers, or if you have something particular, email us and we'll assist you.
All right, so we'll just talk a little bit about, to give you a really basic understanding of how the Canadian retirement system works. It relies on 3 pillars. It's a 3-pillar system. There are the foundational pillar is the government programs. The main one being the Old Age Security, or old OAS. There's also the GIS, which is the Guaranteed Income Supplement, which is tied to the OAS. That's for the lowest income retirees. Generally speaking, won't apply to us. Just so you understand, the OAS and GIS comes from general revenues from the federal government. So it's on the tax base. The other part of that government program is the CPP QPP, which is funded by contributions and investment returns. And we'll talk a little bit more about that later. The second pillar is employer pension plans. We are fortunate to have a defined benefit pension plan. We'll get into some of the details of that, or a hybrid plan for our newer hirees. And then, of course, the third pillar is the savings pillar. So RRSP, TFSAs, or any kind of savings that you may have.
And actually, just on that note, as Hugh said, it's an ever-changing landscape as far as retirement out there. And we recognize for some of the more junior members, they don't have the benefit of a full DB plan at this time. It'll be something the union pursues in the future, making sure you have a secure retirement, not just through Air Canada, but also through the public system. You'll hear a lot about moves being made to improve the CPP system. It's something the labor movement, CUPE, and the airline division is working to try to improve, and we expect and hope that it will benefit the more younger members who do not have the full benefit of a DB plan. So stay in tune to that and support those actions.
That's right. And we will talk a little bit more about that. Just from a very general perspective, like Ross was saying, the system is always changing. The environment is always changing. So the number of people with employer defined benefit pension plans is decreasing drastically, has decreased drastically since the 1970s and 80s. And of course, people's ability to save in RRSPs and TFSAs has declined as well as incomes have dropped. So these are systemic problems that we as a committee and as a union and think about and talk about and try and lobby for. And we'll talk about that later.
So the other thing we wanted to mention before we get into talking about the numbers, we've done these pension seminars for a number of years. We've encountered a number of retirees, people thinking of retiring. And the one thing that we have learned, and you probably even know from your discussion with family and friends, it's not just about the money. It's about what makes you happy. Having a happy retirement, enjoying work. Sure, money makes it a lot easier to pay the rent, eat, go on the vacations you want, but it's more than just about the money. And we strongly encourage members to do some personal retirement planning on those other non-financial aspects. We've recently issued a Bulletin 201, and it has direct links in there. You can click on the links to other resources. So we would encourage you to use that bulletin in tandem with this seminar to help you get started on your planning if you haven't already done so, or complement what you've already done. So in Bulletin 201, there's a link to Homewood Health. And Homewood Health is the company that provides service for our EAP program. You can always talk to the EAP people at your base if you're stressed out about retirement or if you have non-financial concerns and you need somebody to talk to. But we would suggest going into the Homewood Health Bulletin, you register, it's all explained in the bulletin, and when you get in there, we won't do it right now just because of time, but at the top there's a little spyglass or the little search icon. Push on that at the top, type in preparing for your retirement. This will lead you to an online course. It's got some good articles. It's got some good questionnaires. It takes about 2 hours if you do it right. You can look at it once by yourself, but then actually if you have a partner, a spouse, or a significant other that you're going to be entering into retirement with, or who you share habitation with, it's good to do it together because it asks you some of those hard questions that are better to get answered before you stop working rather than when you are working. Like if you're planning to spend your retirement fishing and your partner's planning to spend it gardening, and you may be spending it by yourself. So it's better to know that to start. Anyways, hopefully you both have enough money to plant bulbs and cast bait. Okay.
So your CUPE pension plan, for many of us, it's a defined benefit plan. Defined benefit plans are the gold standard. That's formula-based, just like the CPP is, as an example. The risk is borne by the employer. Defined benefit pension plans are very efficient for members. It's extremely cost-effective. The economies of scale are fantastic. It allows for an incredible breadth of investments. something that as an individual investor, you just simply would not get. Obviously, the new hires, those hired after November 2011, are involved in the hybrid plan, which is partially defined benefit and partially defined contribution. We anticipate largely the audience today contemplating retirement are not involved in the hybrid plan. That said, we will develop bulletins about the hybrid plan and future webinars as well. Like Ross said, this is the first webinar we've participated in. So this is new technology for us, and we will continue to develop this as a method of communication.
So basically, just to let you understand the framework that governs our pension plan, we're a federally regulated pension plan. So employers that operate in the federal realm, like transportation companies, they're governed by federal legislation from Ottawa. And OSFI, the Office of the Superintendent of Financial Institution, oversees our pension. And then the Pension Benefit Standards Act, it's referred to as the PBSA, that's all the rules and regulations specific for pensions. The Income Tax Act has a lot of provisions that do affect how the company administers the pensions, i.e., when we have a surplus, as we fortunately do now, at a certain point, the Income Tax Act does not allow the company, they actually prohibit the company from putting money into the pension plan and taking a tax deduction for that. They actually force the company not to put money into the pension plan, and the company has a contribution holiday. So in the past, people have said, oh, the company's not paying their share. It's not that they're not paying their share. They are covering their responsibility. It's that the Income Tax Act does not allow them to make more contributions. So these are the elements that define the rules and administration of our plan. Also, we have our own pension plan document. It's now a combined text, and you have a pension committee that meets with the company twice a year, and we try to monitor the plan administration.
As Ross mentioned briefly at the beginning, the Air Canada and KL plan texts have now been merged, and all CUPE members are now in the same plan. This is a relatively recent change, although it's been in the workings for some time.
And actually, what's important to note is the way it worked before is all of the Air Canada unions were in an Air Canada main plan. At Canadian, the structure was everybody was in an individual plan. So now the Air Canada main plan has been separated. All the Air Canada members have been combined with the former Canadian members, and the assets have been all segregated for our group. However, in terms of the investment and management of the resources and the money, that's still held in a master trust. We all have shares in that master trust, and the really positive thing to talk about is the financial position of this master trust. And we have to compliment the people that have been in charge of administering and investing our money since 2009. If you see it on the side of the screen, there's a graph that shows the position of our pension plans over the last number of years. And currently, all of the pension plans are in a surplus as of January 1, 2016. We have a solvency surplus of about $1.3 billion and a ratio of 108%. What that means, if for some reason the company stopped operating, the pension plan has enough money to pay all of the pension benefits that have been earned. As you probably remember, back in 2012, we were in a significant and severe financial crisis at Air Canada, and that was spurred on by the position of the pension plan. We had a debt in our pension plan that was more than some small countries. The liability, solvency liability in the pension plan was $4 billion. $4 billion. Do you remember that? We were so short of money in the pension plan based on the way the actuaries assessed it in the rules. It was possible that the company could have been forced into bankruptcy, but the unions came together, and the company and the unions worked with the government, and they bought time, basically. The government didn't bail us out. They just gave us time to work through that problem. The union made significant concessions. You'll recall we changed the pension rules so that we eliminated a lot of the early retirement benefits we had, saved the company significant benefits. The company had to put in more money, and the government gave us more time. At the same time, in 2009, the company hired and put together a new financial management team, and the objective of that team was to ensure that the funds that were invested covered the pensions. It was de-risked, and that's what they did. And so we're in a really good position now. The new investment strategy has been giving us good returns, and it's reduced the risk.
Yes, that is true.
Yeah.
No, that was good. Here, I just wanted to give you a little bit of some definition before we get into the pension plan. We use these terms a lot. So the YMPE, you'll see this number in the formula. It is the year's maximum pensionable earnings. It is set by the federal government. It's Canada's version of the average industrial wage, and it is indexed over time with the consumer price index. Okay, so it climbs over time. Allowable service. This is the number of years you have participated in the plan to a maximum of 35 years, 420 months. Also, your average annual compensation means the annual average over your best consecutive 36 months to a maximum of $80,000. You can reference these at some point at any time as well.
So basically, as Hugh mentioned, it's a defined benefit formula, and we'll talk about that formula later, how it affects your pension. But the important thing to know now that in order to receive an unreduced pension, the new rule since 2 contracts ago is you have to be at least age 55 and have at least 85 points. The points are calculated based on your age and your qualifying service. The qualifying service is the number of months you've actually participated in the pension plan. It's not your company service for your pension eligibility. So it's very unlikely that anyone would retire unless they had very significant reasons for doing so before they reach that milestone, because if you do, there is a very significant reduction in your pension. It's reduced by what's called an it's reduced actuarially, and that's about 6% per year from age 65. So if you go at age 54, you take a huge reduction, and we'll show the magnitude of that. So financially, you're best to make that the sort of the minimum objective you try to get. The other aspect that's required now is consent by the company to retirement. Now, the wording of that consent is partly to satisfy the government, the PBSA, and the tax department, so that the company is not overfunding early retirements. When we're in a surplus, good operating position, you have no concern about consent being denied. And consent is not done on an individual basis. It's done on a global basis. So either everybody gets it or nobody gets it. Nobody has been denied consent. The company hasn't denied consent yet. It's issued quarterly. And like I say, with the financial position of the plan now, that shouldn't be a concern, or we don't believe it should be a concern of anybody. It's a formality to keep the plan in a healthy financial state.
Yeah. All right. So just to review that, the unreduced pension, you have to hit those milestones. So 55 years of age, 85 points, and consent. The DB pension is a formula pension. You have 35-year maximum allowable service accrual. Again, here's that term, average annual compensation. Again, your best consecutive 36 months. And of course, the average YMPE, the year's maximum pensionable earnings, based on the same 36 months used to calculate the average annual compensation. We'll show how this applies in the formula in a moment. Okay. There's no longer mandatory retirement. Now, and there's no guaranteed indexing. This is something we can discuss in the future. This is part of
And actually, while we're talking about mandatory retirement, it used to be that everybody, if you didn't have a plan about retiring, you had to retire at 65. Now there is no more mandatory retirement, so we're finding actually people are now having to think about what time works best for them. They're not going to be told when to leave, so people do what works best for them, their family, their health, and their well-being. And that's an individual decision that people will make. There are certain things people should understand. At age 71, everybody is forced to take their pension. And if you joined the pension plan late and you're still contributing, you cannot contribute past the end of the year when you turn 71. The last thing that was marked on there was indexing. It's important to know, there is no indexing for inflation in our plan. Both groups, former Air Canada and former Canadian Airlines employees will remember when we did have indexing. That indexing was what was called ad hoc indexing. It was negotiated by the unions, it was in the contract, and it was for a certain set period of time. That's something that could happen down the road and in the future. It's something we should set as objectives for ourselves and for the union. And in the interim, before we're able to negotiate something in the contract, there's actually nothing that stops the company from granting indexing. And especially when there is a surplus, we would hope, expect, and we will pressure the company to grant indexing from the surplus, especially when they're taking contribution holidays. We did raise that issue with the company at our last pension meeting, and the Director of Pensions clearly took note of our concern about having indexing in the pensions. It's something they clearly are thinking about and would consider, but they don't feel secure enough yet about the stability and the risk level of the plan to grant it. But I think it's something that we can continue to think of as a possibility down the road.
So this is the Air Canada service formula. Again, this is the normal retirement formula. So again, we use the multiplication factor of 1.75% of your average annual compensation up to the average YMPE multiplied by the allowable service, plus then the portion of your average annual compensation above the YMPE multiplied by a factor of 2% times your allowable service.
And as at the bottom of the slide mentions, the average YMPE from 2014 to 2016 was around $53,000. So if you've always been an Air Canada employee and you made $50,000 for the last 3 years and you retired, your pension would be calculated at 1.75% times 50,000 times your 35 years if you had 35 years. Now, if you open flu or you were an in charge and made 60,000, that extra 10,000, or say 63,000, that extra 10,000 above the 53,000 is calculated at a 2% rate. It's good to know the formula and understand it, but you really, if you don't worry about it, because on the calculator it gives you a number, and at the end of the day, you probably don't care what the formula was. You just care how much money is going into your bank account at the end of the day.
Sure.
Now, the other thing that I would like to note here, because this is a good slide. The CPP, Canada Pension Plan, is designed, if you work and get full entitlement, to replace 25% of your income. So that's why the 1.75 is that amount, because the CPP is paid up to that number. So the idea is that you get a full 2% pension when you combine your Air Canada pension with your CPP times the 35 years, should produce 70% of your pre-retirement income. That's kind of the background philosophy of it. Again, I know everybody doesn't care about the formula, just the more money you get, the better, but this gives you a bit of an idea. This formula applies to former Canadian Airlines employees from June 2000 forward, when we merged with Air Canada, when Canadian merged with Air Canada for service. Before that, it's a little different formula. So for the Canadian group, they have a lower amount up to that YMPE. It's 1.375. So if you and your sister, say, both started, one started at Air Canada, one started at Canadian, you've got the same number of service, you always flew together, you had the same earnings, and you were going to retire together, the person who always been at Air Canada, their pension would be slightly more because the formula up to the YMP is a little more. except for those people who decided to pay the significant amount to buy back the formula amount when it was offered when Air Canada and Canadian merged. So Canadian Airlines employees could pay to increase their formula from 1.375 to 1.75. It was a very expensive proposition. We're talking like $30,000 to $60,000 range. So it was a big hit. A lot of people didn't do it. Everybody looked at their financial position. So everyone is a little different, but the important thing is when you go into HR Connects, you don't have to worry about the formula. It produces the amount that applies to you. And actually, as Hugh just pointed out at the bottom of the screen, the really important thing for Canadian people that the bargaining committee achieved this year, which is a very good thing.
Significant.
It's very significant. In the Canadian formula, it talks about the final average earnings or the final average YMPE. That is now considered the same as your average YMPE. So it means the best 36 months or the best 3 years that you made your earnings will be the same time that your YMPE is calculated, because obviously you want that number to be as low as possible, the YMPE number, because everything above it is at 2%. So once you make your best earnings, say you have a good 3 years and you decide not to open fly, or you have lower earnings, your pension will not go down anymore. For former Canadian people, as you probably know, if your best earnings were in your past, every year the portion of your Canadian pension you'd earned went down a small amount. So that's been eliminated now. There's no problem. Once you've earned your pension amount, it will stay that way.
And that was just no one anticipated when the formulas were created that people's wages would drop.
Yes.
That was the challenge. That no one anticipated that people's wages would drop for a 13-year span before they climbed back up. So the bargaining committee, like Ross said, achieved a big win there and have fixed that.
Like you mentioned, the YMPE, the government sets that YMPE figure. It goes up about 2 or 3% every year. But back when the pension plans were put in place and the people that designed the Canadian plan, they just thought that wages would continue as well. But as you know, we've had significant decreases.
Yeah.
So let's just talk about the role of earnings in your pension. Like 35 years, as Hugh explained, is the maximum number of years you can pay into the pension plan. And then there's a formula. But the other, so you can work your 35 years, but even after that 35 years, your earnings are considered. So everybody knows some people online, or, once they've got the time and seniority, will try to open fly to increase their pensions. So this is an example of if a person, say, increased their, say you're a flight attendant and your rate is around $50 an hour, you do a Toronto turn, get 10 hours every month for a year, you'd increase your salary by $6,000. And if you did that for 3 years, it would increase your average by $6,000. So the impact it would have on your pension is the $6,000 that you'd increase. And because you're over the YMPE, it would be times 2% times the 35 years. So that would increase your pension by $350 a month. Now, if you were under the YMPE, say your best earnings had only been $40,000, you increased them to $50,000. The formula based on the Air Canada formula, 1.75%, you'd increase your pension by $300 a month. So you can extrapolate by that. So say you did 20 hours, increased it by 1,000, you could double it. Again, if you have the full 35 years.
This is a very popular question.
Yes.
Yeah.
And, at the end of the day, I will say from my experience, as we said before, it's not about how much you have, it's about what makes you happy. And what I've learned from people in retirement, it's not necessarily what you've got coming in as income, it's what you've got going out as expensive. So if your mortgage is paid off, your kids are independent, and you don't have any personal debts, you can probably live on a lot less income than if you still have a high mortgage, you're paying alimony to 2 or 3 husbands or wives, all of those extraneous expenses that come along. So everybody's in a specific situation, but you just need to find what balances. And for some people, it's not worth giving up the time to open fly now. They'd rather enjoy their days off and their time now. And there's nothing wrong with that. Everybody makes a choice as to what's best for them.
Here's a little bit of information on what's actually happening with the pension. So 2015, 93 of our colleagues retired. Those that retired before 65.
Actually, I think this is a data sheet from a data sheet we got at our last pension meeting, and we tried to summarize it. But basically, for people up to age 65, the average pension was in the $3,000 range. And for people over 65, the pension dropped to $2,300 or $2,500. That doesn't mean, so the reason for that is you can take a higher pension option up to age 65. At least that's what I think it is. So when they did the numbers, the people are receiving higher pensions to age 65, but then some people have decided to drop down because they start collecting their CPP. So that is, I think, why the average is a bit lower.
We'll elaborate that on a later slide as well.
But basically, you know, you can think of pensions for flight attendants being in the $2,300 to $3,000 range, kind of in that average ballpark. And you know what? It's not as much as some of you are making working, but it's actually more than others are making working. And compared to a lot of other pension plans, it's a pretty reasonably good pension.
Plus, you'll see on that in your pensions, actually Pensions 101 and Pensions 201 bulletin that the committee produced over the last few months. You'll see that in addition to your pension, you have the OAS average, which is about $500 a month, and the CPP average, which is somewhere around $700 a month. And those are both indexed with inflation. So at $2,500 plus your $700 plus your $500, you know, you're looking at $3,700, some of which is indexed, and hopefully your pension committee hopes so too. Your pension plan would be indexed over time in the future too. So it's actually not too bad. It's a pretty good.
So I think everybody probably has a good general background. You probably want some nuts and bolts now. So Hugh's going to take us through the AeroNet and how you can use the AeroNet to give yourself some good personal information.
Now, hopefully, Dominic is there, and I can view additional actions. Here we go. I'm just going to. How do I? Again, bear with us. This is new.
If this is something we've always wanted to do in our live seminars, and we've tried but never really
Your line is now unmuted.
Okay,
Dominic?
guys, so you use the button on the top of your screen that says desktop. Click on that.
Yes, thank you. Yes, that's it. Thank you. Yes, that's it.
We thought we were going to have to do a manual demo.
Okay, so now I'm sharing my entire screen. So we'll just review a couple of the things that we get lots of questions about, just so people can walk through the interface with the HR Connects and the pension calculator. So I'm just going to log in. Oh, it's expired already. I'm going to try that again. See, I was too prepared.
Sometimes you have to quit. Sorry.
All right, so we log in. I'm assuming everybody can see my screen. Of course. This, you would not, you folks wouldn't see this. This is, don't be alarmed. Here we go. Here we go. This is the screen you'll recognize now. There we go. And we're going to try one more time. Again, I was too prepared. Should be fine now. I had to forget it. So there we go. All right. So AeroNet.
We've got liftoff.
We have it. I'm assuming everybody can see this. I'll just assume I can.
Okay.
All right. So we log into HR Connects. Okay, you get to see my original photo. I was hired in 1995. It don't look like that anymore. Okay, so under benefits, retirement, HR Connects pension. So you'll also see, if you happen to have the 201 pensions 201 bulletin there, we recommend you have a look at the retirement guide and planning for retirement. Don't be distracted by this new link here, investment option selection guide for RSP and TFSA. Everyone received all of this documentation from the company the other day. It has nothing to do with your pension, but we will produce a bulletin to explain that. But don't be distracted by it today. Again, it has nothing to do with your pension. HR Connects pension. So we'll follow through here. This takes us to the Aon pension calculator. And what we always recommend is you go, this is what we talk about in all of our bulletins all the time. So you just follow under the pension tab, and the menu here, you choose Run Pension Estimates.
So on the side as well.
It's also on the side over here, Project Your Retirement Income. That effectively does the same thing. Again, we're just going to show you what it does. Here it's anticipating my retirement age at 55. It's showing my pension. The green bar is my projected pension, annual pension. This calculator also predicts your CPP and OAS. It's not particularly good, and as the pension bulletin, Pension 201 bulletin suggests, we suggest you actually take the information you get from your pension calculation here at Aon Hewitt at HR Connects, and take that information and use the Canadian Services, the Canadian Retirement Income Calculator, the CRIC, which I will show you in a moment.
Yeah, as Hugh said, don't be alarmed at changes in the CPP and OAS on your HR Connects profile. The company puts in certain assumptions, and if you have done an estimate, say 5 years ago, and you projected retirement in 10 years, and now you're checking it again, you may find on HR Connect your CPP and OAS amounts are less. And we think the reason for this is their assumptions were too generous early on when they've got. It doesn't mean that you're being shortchanged. So as Hugh recommended, use HR Connect's projection tool to determine your Air Canada pension, and then go over to the Service Canada website to know your CPP and OAS.
Right. So then you can change your estimates based on a date. You can change the date. So this is the last, I turned 55 in June of 2028. So I put my retirement date, my last day of work, as the 30th of that month. And I can retire, the earliest I can retire unreduced 55 and 85 is July 1st, 2028. So the earliest retirement date is 2028.
And actually what happens is your pension retirement always starts on the first of a month. So your last day can be any day during the month, but basically if you retire on March 2nd, or you give notice to retire March 2nd, you will, and you stop working, you won't start collecting a pension until April 1st.
Right. So you can see here, my last day of employment is the 30th of June, 2028. And the date I want to begin receiving my pension is July 1st, 2028. Okay, so you can change these. So I wonder if I have, so you can save those different calculations, and you can compare save projections here on this tab. So I have a bunch of them here, and you can delete them and add them, and you can see I did them in 2013, 2012, so they're a little stale.
So do you have one just before that date?
I don't, but what I will do is I will show you.
Actually, Hugh's going to do a calculation for him just before he hits age 55 and 85 points.
Yeah.
And one after, and then a comparison, just so you see the dramatic difference of that milestone.
Yeah, so here we go. I'll do one the month before. So I'll
Was that
try
one
pick another
saved
date.
already? Did you
Earliest
save
date
that one?
without a reduction.
Other date. Yeah, so you click other date.
Yeah, put the other date. I think I saved that one. Can I save? Where do I save it? Let's forget this. Save.
Save.
Here we go.
And you put a description.
I'll put this
Yeah.
earliest.
Or just put
unreduced.
55, yeah, that's perfect.
Again, so this is 55, 85, and consent. So I've saved that. And then I'll run another one. Pardon me. I'll do it the month before to show you what an actuarial reduction does. I won't be doing it in reality. Let's just put it that way. The hit is substantial. So I'll put May 2028, 31st, and I'll put this as June 1st, 2028. So this is just a month earlier. Redisplay projection. Has to think a little bit. But you can see I dropped from 34,000 down to 2021.
So basically, by waiting a month,
Yeah.
it's going to make a difference of 14,000.
Yeah. Per year.
Yeah, that's huge.
It's huge. Exactly.
That's huge, Hugh.
It is. So I've saved those, and then I can compare them. So I just click on the two of them and view. And it shows you. There you go. Very nice.
Excellent.
Yeah. So that shows you the actuarial reduction.
So you don't have to understand the formulas. You don't have to understand, the components, but you can understand the results. And that's why it's important that you do some projections and you can know when there are certain milestones for you and such.
Now I just want to show you
Actually,
where
on your options, does it show you your options of the lump sum on that pre-65 one?
I don't know if it did or not.
Like pension options, go pension option forms of payment.
So the other thing I wanted to just show you here is this pension forms of payment.
Is that based on the pre-65 one?
This is, no.
Or pre-55?
No, this is the 55 one.
Okay.
So it tells you, it just shows you some of the joint and survivor benefits at 50 and 60%. We'll talk a little bit about that. Higher to age 65 amounts. And this is one of the things we were talking about earlier, why we think some of the people who retired prior to age 65 seem to have a higher pension amount. Because one of the options is to take a higher amount to 65, and then it will drop down after 65. You have to imagine the actuaries that run the financial part of the pension plan assume you're going to live to 85 either way, roughly. And they're going to plan to give you the same amount of money over that period of time. So if you take a little bit more to 65 to give you a bump up prior to your CPP and OAS and all that stuff kicking in, then it'll drop down, and ultimately at that 85 point, you're going to have received the same amount of money, which is why the higher amount is 65 and lower. Or the level, you can take level for life, so you get the same amount.
Actually, when if you put in for retirement now, or you're going to put it in, this is a screen that's important for you to understand, because these are choices you'll have to make in your paperwork. So let me, just while we're here, I was going to talk about it later, but I think we'll talk about it right now. The joint and survivor, 50% or 60%. So this is basically, you get to choose if you predecease your spouse. We have a spousal benefit. So the good thing is, if you predecease your spouse gets a portion of your pension. So you can choose for them to get 50% or 60%. And it depends on your own personal financial positions, your health. Sometimes if somebody is older, they've had a long-term relationship, they're of ill health, and their spouse doesn't have any other income, they may want to provide them with the 60%, so they may choose that. Somebody else may not give a damn, they just want to get the most money possible, they choose 50%, or them and their spouse may think they're both going to live the same amount of time and they have an exit strategy where they're both leaving at the same time. Who knows? At any point, they may choose the 50%. An important thing to know here, and I just want to refer to my notes because I didn't want to forget to mention this. If you choose the 60% option, it reduces your monthly pension slightly. And if your spouse predeceases you in retirement, any new spouse would not be entitled to the spousal benefit. So if you're married and you've chosen the 60%, your spouse predeceases you, you get a new wife or a new husband or a new common law, whatever it may be, they wouldn't be entitled to the spousal benefit. But if you choose the 50% and your partner spouse predeceases you and you remarry, then that person would get a spousal benefit. So that's an important thing to be aware of.
Okay. And then the other thing that's important on this page, at the very bottom here, you see calculation details. This is where you find out, I'm going to click on that. This is where you find all the breakdown of the formula, of parts of the formula that were used. So,
like, actually, a lot of people ask us, how do I find out where my best 3 years is? People say best 3 years, but it's actually your best consecutive 36 months. It could be, 6 months in 1 year, then 2 full years, and 6 months in the next. And this is where you will get information that helps you determine it.
So mine actually does follow in a 3-year span, but sometimes it'll look like it's 4 years, but it isn't. It's portions of 1 year and portions of the last year.
Actually, I think most people, if you go into it, it will list your average annual compensation. It will list 4 years, but then it will give you the average amount, and then it will give you your average YMPE. And basically, you can what your monthly checks are basically. So if there's a year one has say $10,000, and then year 4 has $40,000, you can figure out you had 2 months in year one and 10 months, or 10 months in the next one.
Right.
So that way you can look and see, okay, this is where my best 3 years were, best 36 months. This is what it is. Just helps you plan and decide on what you're doing. Just looking to see it. Oops, sorry.
Go back there?
No, just wondering. Just have a look on that calculation detail again. I'm just trying to think if there's any. So it's good to look at the calculation details and make sure you agree with everything. See if there's anything that's wrong, because you should try to change it. Now, when former CALE people go in, you will see 2 sets of numbers. You'll see the average annual compensation for your Air Canada and your CALE service should be the same, and the YMPE should be the same now. There are some problems with the calculator at the moment in terms of people that do happen to be fortunate enough to be making in excess of 80,000. And there are a few people in that category. And in some of the Air Canada service time, it is projecting more than 80,000. But when they actually calculate your pension, there is an 80,000 cap. So that still does exist.
I was just going to click on the plan information as well under the Knowledge Center, plan information. This is where you can find the Air Canada Pension Plan Employee Booklet. It explains everything about the pension, has the formula in it. In fact, those pictures that we took of the formulas in the slides earlier are directly from this employee booklet. Okay?
And actually, this is where you can find your annual pension statement. You probably get it in the mailbox, but in your secure mailbox, it should be up top there.
Yeah, you're right. Yeah.
Like if you go at the top, your secure mailbox, I'm not. You may have so like Hugh, you can see his pension statements here. Why don't you even click on your last statement at the top, 2015. So you can click on your annual pension statement to see what it is. You've lost it or whatever. And the pension statement does give you important information. So everybody gets this once a year. You usually get it in June or July. the data that's used to do a pension projection is the same data that's used to design your annual pension statement. But it's really good to review those. If there are any discrepancies or you do have any questions, you should let one of us know. Well, first of all, if there's something you don't understand or discrepancy, contact HR Connects. If they don't satisfy you, contact us, because it's better to deal with things sooner rather than try to do it later. That's right.
Okay, I think that's good for that, Ross?
Yeah, I think we're good.
Do you want to look at the other?
Right.
I just wanted to show everybody what in the Pensions 201 bulletin we produced. We recommend you have a look at this Homewood Health site, which is homeweb.ca. The link is in the bulletin.
So this isn't in the AeroNet. This is in the bulletin 201.
Correct. So this just gives you this gives you access to that retirement course that we prepared for retirement that we recommend, just so you know what it looks like. Okay. And then while we're just doing website things, I'll show you the Canadian retirement income calculator. It's kind of an ugly site, but you scroll down here once you get here and you just say continue. And like on the Pensions 201 bulletin, we have a checklist on things to do. That includes getting all the information, getting a formal document from Services Canada about that gives you a proper calculation on your CPP contributions and what your CPP will be. Then going to the employer, the Air Canada HR Connects pension calculator, getting all that information together. And then once you have that, go to this calculator, and it will give you a much more accurate estimate of what your CPP and OAS will be. A whole series of questions here. You can see what it looks like. The Canadian Retirement Income Calculator. Again, all of these links are embedded in that bulletin, Pensions 201.
Can you still go back to the HR Connects page?
I logged out.
Okay.
Then I also, just while we're here, I've got, this is one of the Quebec Pension Plan ones. There's two, again, links available in the Pensions 201 bulletin. This is what they look like.
So the other thing that I think we addressed in the bulletin was in the HR Connect site, you'll see under the retirement, we've got, there's planning for retirement and a retirement guide. The planning for retirement is a little video. It doesn't take too long. It's a good summary. You can watch it. And then the retirement guide is good to read through. It gives you lots of good information.
It is good, this one.
Yeah, it's kind of short. It's a little sort of characters to it. The other thing is you also can find the benefits that are available for you in retirement here. I'm trying to think where the retirement benefits are.
Oh, was that the one we just did?
Yeah. In any event, you can look at the retirement health book. I think we put the links in the last bulletin.
Do we want to walk through the retire now?
Sure.
Do we want to do that?
Why don't we go to the retire process?
I forgot about hitting the big red button.
Yeah. We did say we talk about the retirement process. You can do it on the phone. You can call HR Connects, or you can do it online. Now, the company does request that you cannot put in your notice to retire more than 3 months before the date you're choosing. You can do it less. If you do it sort of within, say, 2 to 3 months in that time span, generally, provided that you do complete all the forms that you receive that have to be completed, they're benefit forms, there's pension forms. If you answer those questions, if you resubmit those bulletins in a timely fashion, then you'll get your final paycheck from work, and then the next month your pension checks will start.
Right.
Now, in the event that you do decide, I've had it, I'm out of here tomorrow, and you give virtually 2 days notice, you can still do that. You can say, I can say today, I want to retire May 1, and I won't be working in May. My last flight will be finished, but it will probably take 2 or 3 months for all of the process to get completed, and you will get a large check that's retroactive for those 3 months.
Right.
And unfortunately, what can happen, what we've heard has happened is, say your pension is $3,000 a month or $3,500 a month, you'll get a large check of $10,000 or $11,000, and there will be a minimum tax that's withheld, which will be quite a bit more than the normal tax you would pay. So, in a sense, if the two sisters I talked about were going to retire on the same day, but one gave notice 3 months ahead and one gave notice the last day, what would happen is the one sister in that first 3 months would probably pay twice as much tax as the other sister. Now, at the end of the year, she'll get that back, but it may cause some initial concern or hardship. So it's good to make a bit of a plan.
And this big red button, the Retire Now button, it does not start a cascade of action on your retirement. I will just walk you through it. I'm going to click on it, and I will not be retiring now. But it just starts the process, just so you can see.
That you did that quite quickly. I missed that.
Yeah.
He's gone.
Yeah, exactly. And some of this process isn't, anyway, just it walks you through it all. It's, and of course, as I say, the little tip here, start early. For a smooth transition, start the retirement process 3 months before you want to stop working.
And actually, there is a retirement checklist. So you can hit the retirement checklist, and it kind of goes through the items that you've got to pay attention to.
There you go. Okay? There we go. We'll walk through all that.
That's good.
Boys, just want to add you can retract your retirement, which the company doesn't like at all, but you can do that. So once you put it in, you can actually retract right up to the day before, but it's something we don't advise you do, but you can do that if you have second thoughts. Okay, thanks.
Yes, and like Nick says, but if once it goes into your first day of retirement, there is no retraction. But if you are going to retract, try to do it ahead. And I would suggest you try to get a manager's signature or something, some confirmation on it, because if you just leave a voicemail for somebody, it may not be good enough. It's a pretty serious step.
And Dominic, do we have the slides there again? We have a couple more just to wrap up.
Your line is now unmuted.
I'll put them up.
Thank you.
Yeah, we're reaching close to our 1 hour time.
Our 1 hour time.
So maybe we'll just we've covered this pretty much.
Yeah, just one note on the actual retirement process with regards to vacation. Just keep in mind that your vacation is prorated for if you work 6 months and you retire, then you can only have used half of your vacation allotment for the year. If you've used more, then you'll have to pay it back.
So a good way to think of it is if two people retire December 1, one person took all of their vacation in July and August, and the other one took all of their vacation in April. The person that took all of their vacation in April will be paid out the vacation because they didn't take what they'd earned. The person that took all of their vacation in July and August used more than they earned, so they're in the last payroll reconciliation, they're going to owe the company money. So if you are taking all your vacation in July and August, you plan to retire in December, you might want to talk about to crew planning about maybe moving some of your vacation to April if you don't want to owe them money.
We talked a little bit about pension options. We'll break it out in a slide in a second. And like Nick said, you can undo your retirement right up to the wire, though the company doesn't like it. It's a
We covered this.
paper push.
Basically, I think we covered this. It was about the questions you'll ask. So that's good.
Yeah. And again, you can see all of the options available to you in the summary of your pension calculation. Next.
Okay, we'll just talk briefly about non-pension retiree benefits. Basically, when you retire, you're entitled to retiree travel benefits. There are health options. There's a supplemental or basic health option, and then there are some insurance options. You should read through the health packages, make sure you understand what's best for you. The majority of the flight attendants choose this voluntary supplemental health package, which is very similar to our extended health at work. And the company administers it. It's a group plan. It has some limitations over what we have at work. It only has about, I think it's $800 a year for dental and it doesn't cover glasses. So it's limited in that area. That's why we say you should try to get all your dental work done and get your new glasses before you leave work. The company just sent out a price sheet for this upcoming year, and to give you an idea of what the cost of something like that is, as of May 1, 2016, for somebody under 65, it varies by province because it depends on how much your province covers. In Quebec, for a single person, it's $39. In Ontario, it's $72. In BC and Saskatchewan, it's $38. And this price sheet is available online through the HR Connects. And that's monthly. You can get it for two persons. And there's some nuances. You can't coordinate benefits. Two people retire and they are both on the supplemental plan. You can't coordinate benefits, that sort of thing. So there's details about this. Actually, in that planning for retirement video, it goes through the benefits. So I'd suggest you review that.
Just a little bit about the CPP, just as a summary. Like we mentioned before, it's a defined benefit. It's paid by both the worker and employer 50-50. Great part about it is it's a multi-employer, so it doesn't matter where you work in Canada. Neither of you can opt out of it, so it just happens. It's indexed over time, and there's quite a bit of conversation now about enhancing it. The Canadian Labour Congress, CUPE, the committee have been trying to lobby for enhancing it. The previous federal government wasn't too keen on that prospect. However, the new federal government is definitely discussing it, and they've actually suggested that they are going to implement some kind of enhancement by the end of this year. Again, the average today is $700 a month. You can see on the CLC, their proposal is to, in fact, double that with only a relatively small premium increase for both the employee and the employer.
Actually, one quick thing I should mention that I didn't mention with retiree benefits. For some people who have not been in the pension plan long enough to be considered a retiree, the criteria for post-retirement benefits is company service. It's not pension service. So if you meet the criteria, even if though you're not a retiree for pension service considerations, the pension department may consider you to have terminated, but you may have enough company service still to be entitled to retiree benefits. So just for those of you who joined late or who were forced into plan late.
And of course, enhancing the CPP benefits everybody, whether they be in the defined benefit pension plan or the hybrid plan. And this is one of the reasons why we like it. And again, little summary, we try to work together to improve the conditions for everybody.
And on that note, as we go forward, it's really important for people that are retired, people that are senior, to continue to fight for improved secure benefits for the junior members. We're lucky enough that we've come through a period where we've had those benefits, and as the last screen says, what we desire for ourselves, we desire for all. And then the other thing we hope is those members that are active fight for indexing, because when you're retired, you're not able to participate in the union negotiations and stuff. So we can go hand in hand as we go forward. Thanks very much for your attention. We hope this has been useful.
Thank you, guys. That's an awesome presentation. Like you mentioned earlier, we've been waiting for that tool for a long time, and now we have it. So thank you. We really appreciate your purple shirts also. That's pretty awesome.
They show purple? Yes.
Before we go into the Q&A, I want to say to people earlier, Russ, you were mentioning that CUPE and the Canadian Labour Congress, they have a campaign. As you know, we are the lucky one to have a defined benefit plan. There's only 35% of the Canadian population who has this type of plan. Despite having the new hybrid version, we're still the lucky one who still have this form of pension plan. So what we are trying to do it's to fight to bring this type of pension plan to all Canadians in Canada. And that's what CUPE is doing with the Canadian Labour Congress to improve the CPP, to improve, we could double this formula. There was a plan that was presented. So eventually it will be, there will be a moment where we could support this campaign and talk to your MP so that they improve the formula of the Canadian pension plan for all Canadian citizens. Also, I want to mention, before we take the Q&A, there was some form of documentation that was sent from Air Canada in regards to the pension RSP, like AC pension plan from the Manulife, and also the possibility to transfer your money into a TSFA, a tax saving free account, or the RSP. Yesterday I was in Toronto. Edith and I were in the comm center answering questions, and one of the things that was asked was to produce a bulletin to inform the members if there is any advantage into transferring your money into the Air Canada plan. So again, this has nothing to do with your pension. It's completely separated, and we will do a bulletin. We will inform you. And down the road, we will do more of these video presentation. For example, for those of you who are on the hybrid plan, and the people who are on the hybrid plan are the people after 2000 and moving forward. So that means that any new hire at either at Mainline or at Rouge are now part of this hybrid plan. Hybrid means an half contribution of a defined contribution and a defined benefit. So we will do eventually a webinar on that subject. So thank you guys. And also for the 2002-01 bulletin, this bulletin was sent last week, I think. It was prepared by the team. Well done, guys. I think there's a huge improvement on the infography also. So that was a really nice bulletin. And if you haven't received this bulletin, let us know here at the component. You could always contact us at contact@acomponent.ca, and we will add your name to our mailing distribution to make sure that you are receiving our communication, and we will send you a copy of that bulletin if you need. So we have questions that we have received from by email. We're going to start with these questions. So Edith, if you would like to read our first question, please.
So if I'm not mistaken,
Your line is now unmuted.
And then we're going to do the ones on the side.
Yeah, I would also invite Nick to turn on his camera if he's still there.
Okay, so our first question comes from Curtis. Pension plan deductions stop after 35 years of service. Now employees do not have mandatory retirement. Why is this still the case? While no longer paying into the pension, are post 35-year employees able to increase their pension amounts by earning more, augmenting their 3 best years, therefore commanding a higher pension, although no longer contributing to that higher pension through contributions. I believe if you're working toward a higher pension, as many have now become very good at maxing out on voluntary extension, employees should continue to fund that higher pension. As it is, it appears like siphoning the pension plan. Thank you. So, I guess there are 2 questions.
Yes, go ahead, Nick. We want to see your face.
I press the button and nothing, the camera button and nothing happens. So, but you know what? I'm not that good looking, so it's probably this as well. Anyways, the question, I think the Supreme Court ruled after an appeal to a human rights decision that was launched by several flight attendants and pilots regarding the mandatory age 65 retirement. So the court ruled that pension plans could no longer force people into retirement. So that, of course, immediately changed the Air Canada plans so that people could work past 65. The other point I think the individual brings up here, which needs to be addressed, is that people that are over 65 that keep working, they aren't contributing to the plan if they've reached their max, same as people under 65 that have reached their 35 years. But these people that keep working, they're actually, in my opinion, saving the plan money because they are not collecting their pension while they continue to work. So the big cost to the pension plan is, of course, retirees collecting their pension, and these people are actually delaying that for however number of years they continue to work. So that, in my opinion, is a much greater savings than the contributions that they're not paying. So I think that concern is kind of dealt with. If you guys have anything to add, go ahead.
Yeah. I'd like to just address that. Just specifically to the 35-year limit, there's no prescription to limit the number of credited years of service. There's like no legislative restriction. There may have been in the past. I'm not sure of the exact history. It's a feature that's commonly used by a lot of pensions, the 35-year max. Some plans will limit 35 years, but allow the consideration of earnings beyond 35, which is what ours do. But it's not something that's limited. I mean, and as Nick says, the people that have paid into the plan, they've made contributions, and the way the company is managing the plan, the company is responsible for ensuring there's enough money in there to cover all the benefits. And as it's been seen in this last year, the way the money has been invested, the money that's been put in by people over their careers has been invested in such that the company hasn't even had to make contributions to cover any portion this year. So I wouldn't look at it as people not paying their fair share after 35 years. It does limit your amount. So the union hypothetically could put this on the table. I don't know, maybe we could put it on the table. It's part of a reopener, I'm not sure. But I would expect the company would resist it because, generally speaking, the cost to the employer of a year of service when somebody is older is a lot higher than what that employee pays. It's not like you're paying the full amount. Like if somebody who's senior goes on leave and personal leave, they have to pay their portion and the company's portion. For example, say somebody 64 took a leave for a year, they would probably have to pay $2,000, and to pay the company's portion, what would normally be required would be more like $8,000. So you can see why the company would resist that.
Yeah, and also, Ross, I think it would be pretty clearly discriminatory if you required the people that had reached 35 years over 65 to contribute, and those that were under 65 that had reached 35 years not to contribute. So that's another issue.
Anyway, so it's a broad-ranging topic, and thanks for asking. Is there another question, Eve?
Okay, so our next, Heather, it's a quite detailed question, so I think we might have to follow up with an email, but we can ask the general part of the question. Are there any doing after mat leave and breastfeeding leave does not make sense? So are there situations where it would be recommended not to buy back if you're on a leave? Like if you can meet all the numbers?
The only way is if you anticipate working for 40 years, where you're going past the contribution maximum. That's the only thing that you would maybe opt to. But I would suggest that, generally speaking, when you're having kids, how can you predict how long you're going to work at the company? So it gives you you get to your full maximum pension sooner if you do the buybacks.
Actually, if I could add to that. So anytime you are offered a buyback where you just pay the employee portion, you contribute what you normally would contribute, and you do not pay the employer portion, we would say unequivocally it's a good deal and you should do it.
Yes.
Okay, so that's when you buy back. Because even for us as employees on our regular contributions, it is a good investment. That's our opinion. Now, the new breastfeeding leave, I'm not sure, but I think you pay the full cost, don't you? Does anyone know? Can someone clarify that for me? Do you pay your cost and the employer cost?
Get back on that.
If you are paying your cost and the employer cost, you'll find it is a bit more expensive. So if you're in a real financial bind and you have to go into debt to do it, then I would maybe think twice about it. if you've got the cash and if you want to retire as soon as possible, then you should think about doing it. But as Hugh said, if your life plan is to have your children and then work beyond when you have 35 years, if you're going to work, say, 40 years, you're going to be here long enough that you could get that time and just pay your portion. But generally speaking, if you have offered the opportunity to do a buyback where you just pay the normal employee contributions, we do recommend it.
Yes.
Okay. Another question from Manuel. Manuel. Hi, Ross and Hugh. I'm ex-Canadian and I didn't belong to the pension plan at Canadian Airlines nor at Ward Air, my starting airline. After the merge with Air Canada, I was able to buy back my pension years, which I did, but could only buy back as far as 2000. Subsequently, when I reach the age of 65, I will only have 25 pension years. I have done my open flying for my best 3 years. With this, my pension is X amount based on the retirement calculator on the HR Connect site. Aside from flying longer beyond the age of 65 and therefore having more pension years, is there any other way I am able to increase my pension by the time I'm 65 years old? Would continued flying increase my pension?
Basically, yes. The more years you have in the plan, up to 35 years, increase your pension. Like so, Manuel, you can. The projection tool should actually show you that. You can do the Freedom 75 plan, I guess, and work till you're 75. But you'll only accrue pension up to the age of 71. And if I remember what Edith said, you had 25 years at age 65. So at age 71, you'd have 31 years. That would be the most you'd ever get. And so other than staying till you're 71, the only way to improve your pension more is by doing a different, higher 36 months.
Right. I was just going to say, I get the impression Manuel is looking to retire at 65. And is there a way to increase his pension between now and then? And now that we have pay scale increases over the next 10 years entrenched, you could theoretically continue to do 100 hours as the pay scale gets higher and higher, effectively making more.
I think it's important to say that even if you have accumulated your 35 years, you can always increase your pension by doing your best 36 years. Wherever you do your 36 years, even if it's after 35 years, it will improve your pension formula.
That's sweet.
36, the best 36 months. But we get your point, Michelle.
Yeah, best.
Yeah.
And I don't think, Manuel, I don't think this applies to you, as Hugh said, that it sounds like you want to go to 65, but if you are contemplating retiring before you reach your unreduced threshold, there is a pretty positive development with the new merged pension language, and you can actually defer your pension till age 65 and avoid the reduction. So that's only if you're considering retiring before you reach the unreduced threshold, but that's something to keep in mind if that is what you're interested in.
So actually, when we talked about that threshold, Nick just mentioned that we said you had to have age 55 and 85 points, or age 65. So if you joined the plan late and you hit 65 and you've only got 19 years, so you have 84 points, you get what you're entitled to unreduced.
Yeah.
Next question, Nita.
Okay, thank you. I have a question from a new hire, actually. So Kizelle is asking, are you automatically enrolled in the company pension plan? Where do I sign up? And this is a great question that we never think of answering, but it's good for the new hires,
Great
right?
question.
And actually, it's great if that person is still here. Thanks for staying with us.
Yeah. So yes, you are automatically enrolled in the hybrid plan. You have a portion of your pension plan is defined benefit. The other portion is defined contribution. The one caveat is the default contribution rate is 1.5%, and you have the option to bump that up to 2%. And if I may say, I know the income is not high when you're first starting out, so every penny counts. But as a new hire, you have time on your side. Time is your biggest asset with regards to investment potential. So the more you can contribute now, the better it will be later. So if you can manage to scramble that extra 0.5% and go into HR Connects and make that contribution through the Manulife provider to bump your contribution from 1.5 up to 2%, I would suggest, Michelle, we would recommend you do that.
Yeah, and if I could add, for those of you who may not understanding, on the hybrid plan, the new hire, you have the option right now, like you were saying, of 1.5, and you could increase that amount. So you have to go in your profile and increase it. And you have year 1, year 3, year 5, for which you could increase these percentage as you go down. So would you say, here's a question, would you say that not only they should increase the 5% because time will make money for them, but would you strongly advise that in the future, as soon as you have the possibility to increase your contribution to the defined contribution portion, would you say that this is something that they should really consider?
I would recommend it. It's the plan that they have. It's you're getting money from the company at the highest rate. You may as well get the money if you can. Obviously, I still think a defined benefit pension plan is better for everybody. But seeing as a hybrid plan is what there is, I think it behooves everyone to maximize it.
Yeah, and the plan is that the DC plan compared to other DC plans is actually quite generous, especially when you get closer to 15 years, because the company's matching contribution is considerable. I don't have it in front of me, Hugh, but
175%, Nick.
Yeah, so that's not bad. So, that's, again, the company giving you money and for you to invest. So it's a good idea if you can afford it. But obviously, when you're at the bottom end, it's really, really difficult to have any disposable income to do things like that. But the more you can put aside, the better off you will be.
And what we find with a lot of people, when you may be thinking of retiring, but the time to start planning for retirement is this young junior person that's just sent in the question. That it may be the farthest thing from your mind, but it sure makes things a lot more comfortable when you reach 60 and you'd like to stop working if you've planned for it and you have the financial assets. It gives you the luxury, if you're ready to retire, to do it. If you don't have the financial assets to afford your lifestyle and your debts, then you have to continue working, unless you have some other options.
Okay. Next question, Edith.
Okay, so we have a question from Bayulna. She asks, where can I find the pension 201 bulletin? Just a side note, the component will be refreshing our website, so it should be a lot easier to find these types of documents from our committees. So
the answer to that would be that if you haven't received it already, it was in our component distribution from the pension committee. If you are not on our distribution mailing list, please send me your email at contact@, and if you would like to be added to our distribution list, it will be your pleasure. Otherwise, we will send you just the document.
Okay, so our next question is from Vola. Can you tell us about the healthcare benefit in retirement? Is there a cap for the $50,000 when you retire, or do you start from scratch?
There's a cap for sure on the supplemental plan and the basic.
You're talking about a lifetime maximum? Is that what it's talking about, Edith? I think they're talking about the lifetime maximum. And what happens is, as active employees, there's a lifetime maximum, and then when you retire, it starts again. It's actually a different plan.
Okay. Yeah.
Is that
okay?
I don't know what the max is. I think it's 50, but it could be 75, but I'm not sure. But there is a cap on both the basic and the supplemental.
But it resets when you start the.
Yeah, it's a brand new plan.
Retirement.
Great.
You sign up, and it's not you're not an active employee anymore. And even though they cover the basic costs, but they don't cover the supplemental costs. But there is a cap on how much you can claim, a lifetime cap.
However, in saying that, if I can add to that, it's refreshed every year by $2,000. So say you're retired and you use $2,000 worth of benefits. At the end of the year, they put that $2,000 back, so you're still at your $50,000. If you use 4,000 benefits at the end of the year, you get 2,000 back, so you're down to 48. So say you use $4,000 in benefits every year. So in 25 years, you'll be down to the 50,000, but then even then, you'll always still get the 2,000. And what we're talking about the extended health, we're talking about the voluntary supplemental health plan. For those of you formerly from Canadian, you'll also be given an option to join what's called the Blue Cross plan. That's a plan that's left over from Canadian Airlines. When we merged in with Air Canada, the Canadian retirees weren't brought into the Air Canada plan. So that's an existing plan that you can join if you want. But generally speaking, most people prefer the benefits and costs of the voluntary supplemental plan that's offered by Air Canada. And then the other thing you should know is you can't decide to join the plan after you retire. If you've retired for 2 months and you go, oh, gee, I don't have any health coverage for my medication or whatever, you can't then go back and say, I want to join. You have to fill out the paperwork and do it before you retire. If you do that, and then say after 5 years, you decide, oh, I don't want to be in the plan anymore. Maybe your lifestyle plans have changed. You've moved to Europe or Mexico and it doesn't work out. After 5 years, you can withdraw from the plan. But once you join, you're in it for 5 years and you have to do it before you retire.
Question is from Faye. Did I understand correctly that after 35 years of pension contributions, although you are no longer contributing to your plan, you can still raise your payouts if you choose to increase your flying hours?
Yes.
Yes, you can. That's a very simple answer. Yes.
Somebody's asking again about the email. It's contact@accomponent.ca, but also the pension committee has an email.
Yeah, they all have different individuals, but I think the easiest way is to send it to contact, and we'll send it to you guys.
Yeah.
Okay. Natasha's asking, do they foresee an opening to buyback soon?
Does Natasha foresee getting pregnant soon? Because then she'd have a buyback. No, other than the regular buybacks, I don't think you should. If somebody's talking about buying back past service before they joined the plan, I don't think it's going to happen. We can always ask for it, but in sort of from my perspective, I think unless you're entitled to one of the buybacks that's currently part of a buyback program, I don't see anything new on the horizon.
And I believe you have 12 months after coming back to buy back, and then it's closed, it's done, you can't do so.
Actually, Edith, I think that's just changed. That's important to bring up.
Yeah.
For anybody that's coming back from mat leave now, I think it's actually 90 days. You only have 90 days to do your buyback, and it has to be done online. We've received several emails from this. Some people, we can totally understand. You come back from mat leave and you're juggling having a new child, all these things. Pay attention to the communication you get from the company, because if they're giving you a deadline, that deadline is firm. If you've missed it, it doesn't matter what your tale of woe is. They don't cut anybody any slack. The deadline is pretty firm, and I'm pretty sure it's not. So if you're having any trouble doing it, call HR Connects. And if you're juggling 2 kids and on hold, tell them to call you back. Say, I can't be on hold while you figure this out. Call me back, and give them a time.
I can't emphasize enough that the deadlines are firm and the pension is not flexible on this.
Okay. Thank you.
Oh, that was it. I was pregnant and missed the buyback. Would they reopen it? That was it. Okay.
No.
So no. So Faye asks, if you have already done your best 36 consecutive months, is there any downside to flying part-time at the end of your career?
Lower wages?
Yeah. So what somebody is thinking, I mean, a lot of people, choose to do that as a phased into retirement. Some people may decide to do a mini block. If you've done 35 years and you do a mini block, for a lot of people, the pay you receive is similar to what you'll receive on your pension. So it may be a good dry run for somebody to see if they can afford to live on that amount. Actually, the pension, if you're entitled to CPP and OAS, plus your pension is probably more than what you'd get on a mini block. So, I mean, if you're worried about whether you can afford it financially, it's one way to do it. The other thing is it's a very good lifestyle consideration because it will wean you off your flying schedule, your flying friends, your overseas shopping. Because basically what retirement experts find is that the majority of people don't reinvent themselves in retirement. They basically continue to do things they've done in the past, follow patterns, maybe take longer to do them or do a few extra things, do it a little more. So it's good from that point of view. As Hugh said, from a financial point of view, you're no further ahead financially probably than if you retired. I mean, one thing that the pension committee had proposed to the bargaining committee was we tried to negotiate some type of a phased-in retirement, but that hasn't happened. And maybe it's something we can look at again in the future if there's enough support from the members.
I think one thing you have to be a little cautious about is the effect of the earnings on your CPP. Because just as with our pension, CPP looks at your whole earnings history from 18 years old on. And if you have years that are included in that earnings history that have low income, it might actually reduce your CPP. Some people, they'll quit work and they'll have zero earnings for a couple of years and they'll go back to work before they collect their CPP. And they'll actually end up with quite a bit lower CPP because of the impact of those no earning years. So that's just another factor. I mean, Ross referred to the phase-in. Our agents have a really nice program where they can work part-time while they collect their CPP, so they avoid this problem, but we wouldn't have that. So that's just a factor whoever asked the question might want to consider.
We've received confirmation about it is 90 days buyback for your pension. So.
Also, maybe just in case if that question was in regards to, for example, you're doing your best 36 months throughout the year, and at the end you're doing mini blocks, there's always the option to buy back the full portion of your pension plan, and maybe someone wants to correct me on that, but there's always the option because I think at the end, you don't want to lose the number of months, you want to keep as many months. For example, the full 35 years, it's 420 months. You want to keep as many months as you want for your formula. So this, at least this way, you're going to keep your full numbers while having the option to do mini blocks at the end of your career.
I think the person had done their 35 years of contribution already, so they can't contribute anymore.
So actually, but Michelle raises an important point. Yes. If you go on mini blocks, you don't want to do that during the period when you're trying to maximize your earnings because your earnings will be less. You can't maximize. So you wouldn't want to go on a mini block if it's part of your best consecutive 36 months. Mm-hmm. But if you've already achieved your 35 years and you do mini blocks, you no longer contribute to the pension, so you won't have pension contributions. Mm-hmm. But like Nick said, you may want to contact Service Canada to find out hypothetically what the impact on your CPP would be. It may not be significant or it may be so small that you figure it's worth it.
And the CPP calculation is a little bit, without getting into a lot of details about it, it's over a 40-year period. And there's an additional year of dropout now. It used to be 7, now it's 8. So there are a few factors in calculating what your CPP is. And you can get specific numbers with a request from Canada Services as described on the Pensions 201 bulletin.
The next question is, what is the tax rate on your pension checks and who do you contact to adjust your tax rate?
Okay, that's actually a good question. And something we should have mentioned is pension income is taxable income, okay? It's calculated at your marginal tax rate, so you you'll enter your pension income when you do your tax, the same with any other income. If you have another job, if you have CPP, and it's paid at your tax rate.
It's important. CPP is taxable. OAS and GIS is not.
So you could do an estimate of what your tax would be by using the tax worksheets, the federal and provincial tax worksheets that are available through Revenue Canada on the website. For most of our people, I don't have it at the top of my tongue what the rate is. Maybe we'll do it we'll include that in our next bulletin. An example of the tax somebody would get. It's you know what? Most people are going to be in the same tax bracket. If you have 35 years in the pension, you'll be in a similar tax bracket as you are now. Yeah. Now, notwithstanding, we did mention the one situation: if you give short notice to retire, you get a lump sum. You'll be hit by a minimum withholding tax, which is probably more than what a normal tax would be.
What effectively happens in that case is if you delay your application for retirement, you're going to get your first 3 months of retirement benefit, your pension benefit, in 1 month, in one check. For whatever systematic reason, the airline is required to deduct tax, and that looks like your monthly income in that one check, but it's 3 months. So they tax you at a marginal tax rate as if that $10,000 payment was your monthly pay. So you can imagine that's $120,000 a year. That's a different tax bracket. So you get it back, obviously, because when you do your taxes later in the year. But that's why it is so high and looks so high, because 3 months.
Same thing happened when we got that bonus.
Yes.
The marginal tax rate went up, and they deducted a lot of tax, and people were yakking about that on the flights. But you'll get the refund at the end of the year. But that's the withholding tax, the rate going up.
But actually, in terms of when you do your pension paperwork, you will get some tax forms, and it'll ask you what deductions. Everybody's entitled to the basic deductions. I think it's a TD1 form. So you'll get this. Make sure you complete the form. You put in, if you're over a certain age, you get another deduction. If you're getting pension income, you get that deduction. And then you'll get a number at the end. When you give the company that information, it tells them what the tax is they should be deducting. Now, if you want more tax withheld, there's a box and you can add to put more tax on. But basically, you fill in the form, and I would suggest when you do get your first checks, your pension checks, look and see what the tax that are taken off, your first regular ones. And if you don't think it's going to be enough to make your tax bill at the end of the year, contact HR Connects, and they should provide you with the form to complete to increase it, because it has to be increased at source. And likewise, if you think for some reason you're getting charged a lot more, there should be a way for you to reduce it. Like I say, we'll try to deal with this a little more in depth in maybe a side bulletin.
But the bottom line is, generally, you treat your pension as income, and it's taxed in the same way. So unless you're getting a big amount up front, I think that's normally how you're going to consider it. So the same tax rates that apply to your income should apply to your pension as time goes on.
Okay, our other question is, where do you find the dates of your 36 best months online in HR Connects? And if I'm not mistaken, you went through that already.
We sure did.
So
yeah, sure did. So you can see it earlier in this presentation, but when you go through your pension calculation, there's a calculation details at the very end of the pension forms of payment. So you choose pension forms of payment tab, scroll down to the bottom of the page, the calculation details. That'll give you all of that information.
Yeah, you click on detailed calculation, right? And then it brings all the rest of it.
If you join us,
yeah,
just after Hugh walk us through. So once we are conclude with this presentation, we will send you a link, and everything is recorded, so you'll be able to watch how to get to the information on HR Connects, or you will receive your pension statement at the beginning of June for the year 2015.
So Sherry, they went through a whole detailed walkthrough of HR Connect, so it will be easy for you to see once you watch the recording. Additionally, is there anywhere online that you can see the breakdown of time when you have no contribute to pension, mini block, special leave of absences? Oh, I guess the times that you were off the payroll and you were not contributing. Will there be a list on there of those dates? But
No, there's not. It's, I mean, I can understand why somebody, especially if somebody has large gaps in service. Actually, one thing I maybe should just mention, it just occurred to me, people are wondering about their earnings and stuff. The earnings that are recorded for your best earnings for pension, it's not what's on your T4. So pensionable earnings are different than what's on the T4. There's some taxable benefits that are included in your T4 that aren't considered earnings, and commissions is one of them. Not that you make a lot, but just for example. So probably if you're wondering if you think, oh, it's lower than my T4, if you want to check what it is, the best replication of what is used as pensionable earnings is your grand total pay. You know, you get your pay summary, and at the bottom it says grand total pay, and that basically is your pay from your flying and your training pay. That's more or less the number that should add up. So if you add it, if you had a certain time period that said you earned so much, you could look at your grand total pays and add them up, and it should be pretty close.
Maybe to answer, the best way to find those gaps potentially is to phone HR Connects and choose option 2.
Mm-hmm.
You can look at your payroll statements, which is a pain because it jumps all over the place, but you can go way back with that, so you can just see what earnings you had in each year.
And if you have sorry, Edith,
job history. If you go to job history, you have a whole list of when you changed your pay grade or whatever, and it says it there. It shows your leave of absences. It shows all the times you were off the payroll. There you go. I taught you something.
Oh, you did. Thanks.
I have a question.
Sorry, this discussion made me think of one other thing. So you get a month's pension service. It's called allowable service that goes in that formula, provided that you're on the payroll at least one day in a month. So say you have an overlap. You have an overlap 4 days into May, and then you take the rest of May as a personal leave. And you're not in your best 35 years, so you don't care what the earnings are. You're entitled to a month's credit without having to do any buyback. So if you do that, use that strategy, I would call HR Connects to ensure that you did receive the month's credit for that. And also, like Nick said, you can look at your paycheck. If your paycheck for a pay period shows a pension deduction, then you've received credit for that whole month. Now, this is different for mini block. With mini block, if you work a partial month, you only get 60% of credit for that month unless you have done the top up. So for mini blocks, if you choose mini blocks an 8-month program. If you don't top up, you get 5 months credit. If you top up, you are getting the other 3 months. So again, with mini blocks, it goes back to that buyback question. If you think you're going to work beyond 35 years, you might not want to pay for the 3 months because you pay the company portion on that.
You guys, we're done with the question on the side, but I have a question for you because we have lots of people that are retiring, considering retiring in the future. So what is how can we expect to receive, for example, let's say I would want to inform the company that as of September 1st, I will be leaving this company, okay? How long can I expect to have my first check in hand from the employer?
They've actually gotten really quite good at administrating this now. We did go through a very bad phase when they were converting to Aon, so there were big gaps. So I know people have heard these stories, but I think, and the fellows on the committee here can correct me if I'm wrong, but I think that if you apply in that prescribed period between 60 and 90 days prior to your retirement date, I would say you will get your first pension benefit on your first day of retirement.
You're supposed to get it the next month after you retire.
Yeah, that's right. Yeah. No, I think they're very efficient. They're good now.
Awesome.
Yeah.
Any other questions?
Yeah,
Edith?
we have one from a new hire as well. Best advice to us new hires about planning and looking at our retirement papers have been sent to me. Not sure how to go about it. From what I gather, it's best to increase from 1.5 to 2%. Any other advice for us new hires in the hybrid plan? So any advice that you can offer?
PLC and CUPE and the Air Canada component in lobbying for the enhancement of the CPP. That's a really big thing for new hires.
Try it as much as you can, as young as you can be, and then you're going to benefit when you get old like me.
Yeah, and I if I could add to that, to answer your question, Michelle, if you can maximize your RSP, they are complement to your pension. You know, of course, you can your contribution will be limited because of your pension plan, but the next step will be to maximize your RSP.
And I mean, personally, I think you know, the environment over the last 5 years has not even entertained the concept of enhancing the employer pension plan. But I tend to be an optimist, and there's no reason why we can't contemplate and discuss enhancing an employer pension plan in the future. So we can get you know, supporting each other in trying to negotiate that, I think would be great alongside enhancing the CPP.
Just for the record, Hugh, we did try in this round of negotiations.
Yes.
I know we were in discussion with you guys.
Especially the indexation, you know, but we'll see in the future. So I
Agreed.
just want to go ahead, Ross.
Oh, sorry, Michelle. Just before we go on, I knew I had an email that really addressed the question Edith asked just a minute ago. So I just want to share it with everyone. I'm not going to give the name, but I got an email from somebody who retired recently, and it just says, "Good morning, Ross. Hope all is well with you. Retirement is wonderful. I just wanted to let you know, this is somebody who I knew was affected by the YMPE language. So somebody from Canadian whose earnings were in the past and was retiring. So just wanted to let you know the difference in my pension amount, presumably from the changes in the contract, which they were. When I submitted my intent to retire immediately after the contract was signed in late November 2015. So they submitted their intent to retire 3 months in ahead. The calculations on the Air Canada website showed my pension at $2,700. My actual pension has increased by $140 based on the change in the contract. So that's a positive thing. But what I want to go on to is she tells me about the process and how it worked. I received my first pension check on March 1st, 2016. Since my January pay was deposited in February, there was no lapse of incoming monies waiting for the pension. FYI, for anyone wondering how long they needed to wait for their first check, if you put in it, give enough notice and fill out the forms, your paychecks keep flowing. I found the retirement process with Air Canada painless and quite simple if you read everything. And the resulting retirement, well, there are no words to describe how liberating this next phase of life feels. See you later.
It's great.
That's awesome.
Okay, we have a couple more questions. You reminded me about YMP questions. I'd like to know more about how YMP influences your pension. Are individual monthly pension deductions based on our total earnings or on the annual YMPE?
Your contributions are 4.5% up to the YMPE and 6% on the amount over the YMPE. So that's a set rate.
And just as an FYI, YMPE year maximum pension earning is the average salary here in Canada. You could find on the Canadian website the information.
Okay, so then
And I might
2 other questions.
I might also add, just for reference, so that our members understand, 4.5% and 6% contribution rate is extremely low. Extremely low.
Yes.
My brother is a teacher in Toronto, and he contributes 13%.
They have a much more generous pension.
Oh, don't get me wrong, they have a good pension, but he pays for it.
Yeah, and Hugh's right, which is a bit of a problem for us because the employer is on us about that. They contribute 2.5, 3 times what we do, so it's a bit of an issue with actually the government and the employer. But so far, we've been able to hold it, and that's
I agree. I know they've been on the line. Agreed. But just so the members understand, and there are some other smaller pension plans in the country I've heard that are upwards of 18%. 4.5 and 6 is
not too bad.
Not too
from
bad.
6 to 9.
Okay, so he continues with, are the online pension projections on HR Connects based on current YMPE or on the estimated YMPE from our selected retirement year?
Well, Ross can correct me, but the YMPE is only firm in the current year, and it's indexed with basically the CPI. So I think the projections are based on that. So the Aon Hewitt will do their projections of what they think the YMPE is going to rise every year, but it isn't set in future years. Just estimates.
Actually, sorry, Edith, I know you guys sent that question to me and I was going to check the assumptions on HR Connects. From what I recall, at one time they did have an estimated increase in there. I don't think it's in there anymore, so I think it's based on the current YMPE. But we'll follow that up and we'll clarify that in another bulletin. Sorry about that. Like I say, the company can put certain assumptions into the calculator, and there was at one time a 2 or 3% projected increase. They may have changed that, so we'll have to get back to you on that.
Can I ask?
There's a possibility that they're using the current YMP for future years now?
Yeah, there is. At one point, I remember they were talking about maybe doing that, but
just sorry, are you done, Nick? Edith, just to clarify, was there an additional part of that question? Was a YMPE? Were they also asking how the YMPE affects their pension earnings, pension benefit?
No, the question was about the contribution.
This contribution.
Yeah, our pension is no longer indexed. Is the pension income occasionally adjusted by the pension plan itself to help compensate for inflation, or will one's monthly payment always remain the same during retirement? Say if one retires at 55 and dies at 85, always with the same income?
At the moment, it'll always be the same.
Yes, but there was ad hoc indexation in the collective agreement from 2002 to 2007. And which was half the rate of the CPI up to 4.5%, I think. That's gone, but it's always the goal, as Michelle and Edith said, they tried to get it earlier to get indexing in each collective agreement. So that'll be the hope for the next collective agreement, to get some indexing. And, you know, the employer, there are pension regulations and in-tax provisions that do make it difficult to get indexing from the surplus, but in my view, you can get around that by putting it in the collective agreement. So these are things that the union will try to get again for sure.
And again, this brings the point that Ross was making at the end of our presentation, that supporting young new hires, et cetera, these are the members that will lobby for indexing once you have retired.
Yeah, so let them pick their positions.
Yes, yes, exactly.
Can I? Sorry, Edith. While you were talking, I just went into the assumptions in the calculator so I can provide that person for an answer about the YMP that's used in the projections tool. So the final average year's maximal pensionable earnings, this projection uses the last known YMPE for all future years. So it sounds like they use the last known YMPE.
There you go. So the last question is, what happens to my pension when I die if I don't have a spouse?
I'll take care of that one. So basically, if you do not have a spouse, it depends on how soon you die after you retire. So basically, if you retire, you go for a beer, you get in a car accident, you haven't collected any of your pension, and you've got beneficiaries, they will receive the full value of the contributions and interests that you've made while you retire. So that's, you've already retired. You're in your retirement, and you're no longer on the active payroll. So the contributions and interests that you've made into the plan are not kept by the plan. They go to your estate and to your beneficiaries. If your kids are designated, that would be them. So if you have a spouse, the spouse gets, if you chose 50%, they'll get 50% of your earnings or your pension until they pass away. Now, if you have been retired for more than 5 years, generally speaking, within 5 years, most people have collected a pension that's equal or more than their contributions and interest. So if at that point you become deceased, you've already collected your contributions and interest, there would be nothing that would go to your estate.
Before we conclude, gentlemen, we do not have any more questions. First, I want to thank you, the Pension Committee. You are such a great asset to this team. You're a great asset to our members. It's a pleasure working with you. We're looking forward to doing more of these webinars. We'll do other subjects. Of course, we will keep doing our roadshow, live roadshow at each base eventually. And thank you for all of you who have participated. Invite our colleagues. This webinar is recorded. You will be able to watch it at a later time, and we will do more of this. So thank you. Thank you for all of you who stayed on your presentation, and see you soon.
Yeah, I'm out of
Thank you.
Perfect timing.
Thanks, guys. Thanks, Dominic. Great job.
Thank you.